This Kitco News interview is brought to you by Goldback, inflation-resistant, 24-karat gold currency.
I'm Jeremy Szafron. Welcome back to Kitco News. Well, my next guest says ending the Federal Reserve would be the greatest economic achievement in a century, eliminating inflation, ending recessions, and of course, shrinking government control over the economy. And according to him, it's also embarrassingly easy. Here to explain why this idea is gaining traction and to challenge the critics who spread fear, uncertainty, and doubt about dismantling the Fed is Peter St. Onge. Peter, of course, is an economist at the Heritage Foundation, a leading voice in Austrian economics, also a Bitcoin advocate, and he's known for his incisive daily videos and weekly podcasts on economics and, of course, freedom. Great to have you on the show. Welcome back, Peter.
Great. Thanks for having me back on, Jeremy.
All right, we got so much to get into here as we wrap up 2024. I can't believe we're saying that. But I want to start with one of your latest newsletters. You write that ending the Fed is not just science fiction. You point out that America didn't have central bank for its first 140 years. I mean, we had air conditioning, telephones, and even electric cars before we had the Fed. But before we get into that discussion, we obviously have to address the latest FOMC policy meeting, which happened yesterday, wrapping up this year for investors. And at the end of the day, I mean, the U.S. central bank cut by another 25 basis points, bringing the total number of cuts to a full percentage point since September. It's also now projecting only 2 rate cuts next year as inflation remains stubbornly high. And at the same time, we have growing concerns about the U.S. debt levels, the strength of the dollar, and of course, growing de-dollarization efforts. Peter, you were obviously probably watching Jerome yesterday. What were your key takeaways? I mean, what was his messaging signaling to you?
Yeah, I think his messaging has pretty much been continuing the messaging from the Fed over the past year and a half, which is that they screwed up. Yeah. They told us that inflation was going to be transitory. They were very clear about that. They were confident. And pretty early on, Jerome realized he had screwed up. You remember he said, monetary policy is like navigating by stars on a cloudless night in one of his particularly poetic summations. And of course, if you're navigating by star with no clouds, that means you have no idea what you're doing. So that was accurate. He also, at one point, I believe early last year, he was at a central banking shindig where he said, he was asked about the transitory inflation miscalculation. He said, well, at least we've learned how little we know about inflation. So this guy is signaling to the world that he has no idea what he's doing, which is refreshing because the Fed never knows what it's doing. But at least this guy's ready to admit it. So this is another one in the list. And what he came out and said yesterday was essentially that they do not have a handle on inflation. This is now 3 years into transitory inflation. It's still not going away. It's been sticky. They have a price measure that they track at the Fed, which is a sticky price index. That has barely budged since the height of Bidenflation. They have not made fundamental progress. Inflation keeps sort of edging down and then it comes back up again. And then they edge it down a little bit and then it comes back up. So it looks like we're stuck at about 2.6, which is about 30% above their target. And they're not making progress. Now, meanwhile, specifically what he's concerned about is that there are a couple of policies from Trump that are potentially inflationary. So one of them is tariffs. Tariff is essentially a sales tax, so that raises the final cost of products. It's not a big hit, but it is a hit on inflation. And the other one that he's concerned about is Trump tax cuts. And I think that's kind of fascinating because it illustrates how the Fed functions. One of the main things the Fed does, which is to squeeze the private sector, right? Squeeze families, squeeze business spending, basically bulldoze the highway so that federal spending can drive real fast. Right. And the concern here, that's what's been happening. So the Fed hiked interest rates. It was the most vicious series of hikes since the 1970s, what they laid on us the last couple of years. That essentially cleared the highway. Right. So it squeezed families. That was a big reason why Trump won. It squeezed business spending relative to what it should be so that the federal government could keep spending. And so what he's concerned about at this point is that Trump wants to reverse that. So Trump wants to cut taxes. He wants to give people back to people. Give money back to people. He wants families to be spending again. He wants companies to be spending. He wants banks to be lending. All of that is fantastic for the economy, but it means that the highway that the Fed cleared with their bulldozers, well, people are going to get driving on that again. So what you have to do at that point is that you have to head that off at the pass, right? So the Fed can jack up interest rates again and squeeze families even harder. That's not going to make it very popular. So the alternative is that you have to cut government spending.
Yeah, there's so much to unpack. You were talking about what Powell has been saying all year. He's quite the lyricist. I mean, he comes up with some interesting quotes. Yesterday, he said that the U.S. economy is in a, quote, good place. But of course, we've seen financial conditions tighten. Job revisions point to a weaker labor market. What's the Fed missing, Peter?
Yeah, so when he says good place, he means relative to the other clowns all over the world. So Europe, Canada, Japan, places like this. The Fed's own projections are looking at about 1.8% growth over the next 3-4 years. That's pathetic. In historical terms, that is absolutely pathetic. In the 1950s and early 1960s, before the federal government broke the economy, so Nixon and LBJ, in the 50s and 60s, we had about 4.5% growth. That would be a good place. We had low inflation. We had consistently 1 to 2% inflation during that period. That would be a good place. When Powell says good place, I'm not sure. I suppose he's comparing it to Canada, but we are not in a very good place.
Oh, good.
We are very close to stagflation.
Yeah, no, that's worrisome, Peter, if they're comparing it to Canada, specifically with what you're seeing there. Yeah. Okay, I have to talk to you about your outlook into, the macro environment going into next year. Obviously, all year we've been seeing, this revisions on the job data. We've been getting revisions and data revisions from the Fed and from the economy. What's your macro outlook going into next year with this latest from Jerome Powell yesterday?
Yeah, it's been shocking. There was a time when if you doubted government statistics, you were a crazy person. And a lot of us did start to doubt them because the numbers were not adding up. And especially if you looked at public sentiment. So a majority of Americans a couple months ago were saying we're already in recession. Then you look at the GDP numbers and they're allegedly at 3%. You look at the job numbers, it's allegedly a historically tight labor market. And at that point, you dig into the numbers and there were all these anomalies in there. And oddly enough, since then, they keep putting out these massive revisions to the government numbers. They lopped off, I think, about 800,000 jobs about 6 months ago, where they said, well, they weren't really there. We're looking at more revisions coming down the pike. One of the sort of parlor games is whether all the statistics are going to come clean as soon as Trump comes in, and then they're going to say, look at what Trump did to the economy. Well, no, your government-paid statisticians suddenly started telling the truth. But really, the $64,000 question at this point is, are we going to have a recession next year? And I think we were lined up for it. We may well already be in it. We don't know. Because remember, the NBER, which is the sort of official arbiter of whether we're in a recession, they typically don't announce until a year after the recession starts. That's what happened in the 2008 crisis, right? All during 2007, they waited like a year to tell us that the recession actually started. So we don't know if we're in a recession yet. My base case is that the Biden economy has delivered a recession. It's papered over by government spending, by handouts for green projects, things like this. But the sort of fundamentals of the economy, like, for instance, if we look at manufacturing, we've had a manufacturing recession in everything except for the stuff that's getting government handouts. So that is not sustainable. That's not a fundamentally healthy economy. It's not an economy in a good place. And so the question at this point is, can Trump's reforms turn things around fast enough to head off that recession? And the trick there is that a lot of these things have, they have delays on them. Like if you cut corporate tax cuts, or corporate taxes, it takes a while for companies to make decisions, to build factories, to go ahead and hire people. That all takes 12, 18 months. Regulations could have a faster impact. In other words, they could remove regulations much faster. That's one of the things they're talking about doing with DOGE, the Department of Government Efficiency. So you can slash regulations or at least suspend them overnight. But again, it's going to take a while to actually see that translate into growth. So if you loosen up the restrictions on oil drilling, for example, it takes a while for those investments to actually get created. So my base case is that we're going to be very close to a recession if we don't dip into it. And then towards the end of 2025, things start to come back up as the Trump tax cuts and deregulation start to have an effect on the economic numbers.
Yeah, everything takes a little bit of time there. Okay, before we get into, some of those Trump policies, including the tariffs, let's discuss why ending the Fed is not science fiction, as you call it. I mean, I want to point out that this idea has been gaining a lot of attention this year. There's definitely a shift happening with more people understanding what the Fed is doing with its monetary policy. For those of our audience who are still trying to figure this out, can you break it down a little bit? Why are we in this financial mess, and how did the Fed contribute to it?
Yeah, so a central bank fundamentally, the reason governments create them is so they can have a licensed counterfeiter. They effectively have permission from the government to print up money. And the reason governments do that is that central banks then buy government debt. So they essentially finance the government's own debt. And typically there's an assist in there where the financial sector gets a nice fat chunk of the printed money in the form of subsidized loans. So Wall Street can then lend that out and they can make profit on that. So it's kind of this ungodly trio where you have the counterfeiters, the government, and large banks. That's fundamentally sort of how they're created. That's definitely how the Fed was created. It was the Federal Reserve Act was literally written by the mega banks back in 1913. And the problem is not only does that create permanent inflation, so before the Fed, right, the first 123 years of the Republic, we did not have any aggregate inflation. We had inflationary periods, we had deflationary periods that had to go with, you had gold mining, you had wars, right? You had various things happening. But in aggregate, the prices in 1913 were the same as they were in 1790. Okay, so inflation, a lot of people, when they hear about the Fed, they read a newspaper article about the Fed fighting inflation, quote unquote. The Fed is the only cause of inflation because it prints money. It just, it prints it up on Excel sheets. It types out a bunch of zeros. It says, announces loudly, this is money. And then it goes out and buys things with it, primarily government debt. So the Fed creates inflation. The other problem with the Fed is that the main mechanism that the Fed uses to create new money is artificially interfering with interest rates. Okay, so if they manipulate interest rates, typically too low because that benefits Wall Street. If you do that, then you get this sort of tissue fire economy where the economy is growing too fast because money is too cheap. You get a bunch of stupid projects that get funded. For example, Hawk Twa Girl or Fart Coin are in the news at the moment, which suggests that money is indeed too easy. You get all these stupid projects that get money. And then as inflation starts to rise, because all that money flooded out, now they have to hike rates. When they hike rates, a lot of those bad businesses called malinvestments, they go under. So you end up getting this boom bust cycle where you get the tissue fire and then the collapse, and the tissue fire and the collapse, which is called the business cycle. Now, the business cycle does not exist outside of central banks. It is not natural. Companies make mistakes, sure, but they make it randomly, right? So every year, 1% of businesses go under because they were idiots. It takes a central bank to make all those errors cluster up. So you get like 1 year where 5% or 7% of businesses go under. So those are the two main problems with a Federal Reserve or a central bank. They create inflation. They create boom bust cycles with recessions. And so then the question is, all right, well, how do you get rid of it? So there are countries in the world, generally small countries, that don't have central banks. There's about 8 countries at the moment. Argentina may be about to join them with Javier Milei's reforms. And my suggestion for how to get rid of it is pretty simple. What you would essentially do is restore the gold standard in a sly roundabout fashion, which is that you would announce a price target, say, take the current price of gold, so call it 2,600, and anybody could go and buy that gold from Treasury for $2,600. And the key point is that then you would have a law along with it that says, all right, but if people are buying Treasury's gold, then Treasury has to go out and replace that gold on the open market. And they have to do that before they pay a dime of interest on the national debt. What you're doing there is you're sort of setting up a system where if people are buying gold from Treasury at 2,600, the only reason they would do that is because the official gold price has gone above 2,600. The only reason that would happen is because there's inflation. They're printing too much money. So by putting that straitjacket on them, you effectively reimpose the gold standard. That means that the Fed can do much less damage because it can't sort of blow out those economic tissue fires, right? It can't grow the economy too fast, because if it does, you're going to get immediate inflation. You're going to get gold draining out. Now the treasury is stifled, and the sort of human hostage that you have on all of this is the debt payments, which fundamentally go to large banks, they go to large pensions, they go to characters who have a lot of political muscle. So this is my suggestion for how to get rid of it. You get a twofer. Not only do you get rid of the central bank effectively, or at least you severely constrain its ability to screw things up, you effectively reinstall the gold standard, at least for the US dollar. If you do that for the US dollar, every country on the earth is going to have to follow, or else there's going to be a giant sucking sound of people from all countries around the world trying to buy dollars.
Yeah. Okay, I want to take a step back there, because you just explained a little bit about how you could possibly end the Fed. But talk to me about the legal aspect of it and how we'd get there.
It actually wouldn't be that hard. You repeal the Federal Reserve Act, which was passed in 1913. You could make an argument that you'd actually do it with 50 votes in the Senate, which you can do for any bill that primarily involves budget, which this clearly would be. Or at any rate, you can make an argument for it. I would say it clearly could be. So it actually wouldn't be that hard. You would need some kind of sort of cleanup legislation. There are functions that the Fed does that I think most people are okay with. For example, regulating banks. They're not very good at it. But at any rate, you could transfer those functions over to Treasury, which already does a lot of that. You've got the OCC, for example, the FDIC. You have multiple organizations inside the Treasury who regulate banking and payments. There's absolutely no reason why that has to be done by a private organization that's not even government run, i.e. the Fed. So you just transfer those functions over. What you would lose is the bailout function. So this is another major function that central banks engage in. And this is called they call it the, quote, lender of last resort function. And in their minds, what happens is when banks, through no fault of their own, run into trouble, then the central bank stands ready to support them and to lend them all the money they want. Now, of course, if you do that, what you're effectively doing is telling the gamblers that, look, when you guys play at the blackjack table, if you win, you can keep it. But if you lose it, don't worry about it. We're going to cover it. All right, so you create a massive moral hazard that makes the banks extremely risky. That's when you need the regulatory functions on it, right? So in other words, the only reason why you need a central bank to sit around policing banks is because you've given them that lender of last resort. So that would be one of the glorious side effects of getting rid of the Fed altogether, is that you would no longer have bailouts. If you don't have bailouts, then the banks have to be prudent by actually being prudent. They can't run risk up right to the edge on the expectation that the taxpayer is going to bail them out.
Yeah, well said. Licensed counterfeiter. I like that one. I might use that one, Peter. Okay, I want to talk about the U.S. dollar. I mean, it's been at the forefront of President-elect Donald Trump's mind, who, has promised that he would keep fighting that the U.S. dollar is the world's reserve currency while trying to weaken it at the same time. I mean, what happens to the U.S. dollar without the Fed?
Yeah, Trump has been sort of Jekyll and Hyde on the dollar. At times, he said that we need a weaker dollar. Countries in general like to have a weaker currency because it benefits their exports. It makes them cheaper. So, we could get more market share in China or Japan or whatever. So at times he's advocated a weaker dollar. J.D. Vance has generally advocated a weaker dollar. And then at other times, for example, he lashed out at BRICS. He said any country that tries to go in with the BRICS currency, he's going to slap 100% tariff on them. So I imagine in his mind, there are two separate topics. So BRICS has to do with China extending its influence over the world, whereas he sort of knee-jerk prefers a weaker dollar for exports. But I'm not sure he's entirely resolved on that. And, a lot of us are sort of watching who he adds to his team in terms of how many people are weak dollar, how many are strong dollar. Mm-hmm. But I think sort of on the longer term, what we're probably looking at is, I think governments all over the world have gotten used to very high debt levels. They're sort of addicted to it. The problem is once you run a massive deficit, you then grow the government to match that deficit. And when you grow the government that big, that's made of people who have, they lobby, they have interests, they have corporate allies, perhaps. So it's very, very hard to shrink it. So I think that governments really all over the world, they jacked up debt spending during COVID, I think they're going to have a very hard time bringing that down. And so that argues for a sort of generalized slow motion crisis for paper money in general. But specifically, if you get into a sort of crisis period for paper money, then I think what happens in the near term is that that's very positive for the US dollar. The metaphor I use is that the road to fiat death is lined with the corpses of weaker currencies. So, as people start having doubts about government's ability to repay, about whether they're going to try to use inflation to sort of square that problem, I think that all of that sort of encourages investors to move away from weaker currencies, perhaps the euro or the Australian dollar and so on, and move back towards the US dollar. So I think in the near term, that sort of longer fiat disaster scenario is sort of paradoxically a good story for the dollar. And then, of course, sort of concentrates all their eggs are in one basket. And then we have the final boss battle.
Yeah, well said. Okay, you before talked a little bit about the gold back there. I want to talk to you a little bit about gold. And how much is in Fort Knox? I mean, how much gold does the U.S. hold? And why is it not priced in current market value, which is around $2,600 an ounce?
Yeah, that's one of the big parlor questions. Is the gold really there? Is it rehypothecated? Has it already been mortgaged out to the Chinese? Who knows? This is one of Ron Paul's sort of moves has been to audit all of these things, and they've been very, very resistant to do that. I think not repricing the gold is mildly positive in terms of, I think there have been various people involved in some of the monetary decisions in the U.S. who have wanted to sort of hold the gold outside of play, sort of keep it off to the side, a little bit like how the King and Queen of England, right? They're sort of standing off to the side as this backup government in case they really screw the pooch. And I think that there have been various moves to sort of ring fence the gold holdings in the U.S. and put them off to the side and sort of pretend they're not there because that's the backup if things really go wrong. So I'm a little bit nervous. I know there have been some proposals to reprice those dollars and then to for example, issue bonds against them. I'm slightly uncomfortable with that under current management. In other words, with the current Fed and Treasury stance that we have, I'm a little bit more comfortable kind of continuing to keep those out of the fray, off to the side, pretend they're not there, let fiat do whatever it's going to do, and then that gold stands as a backup if we need it.
Okay, so it stands as a backup. Why did the gold-backed dollar fail in the past? And as you talk about it, will it work now?
Yeah, so, of course, the dollar didn't fail. The government failed, but right. So, so the gold-backed dollar was doing exactly what it was supposed to do, which is that it was safeguarding the value of the dollar. And what happened in the 1960s is guns and butter. So they tried to simultaneously spend more money than we had on foreign wars, specifically Vietnam War, but really all over the world. We had, soldiers in Germany and Japan and all over the place. And then at the same time, they tried to do the butter, which was handing out these, in today's terms, trillions of dollars in welfare spending to build the so-called Great Society that turned American cities into hellscapes. And so the amount of dollars involved in that, they were spending so much that they were creating inflation, and gold did what it's supposed to do. It was the straitjacket saying, you got to stop this, you got to cut down on the spending. So at that point, they had a choice. They could either cut down the spending, and, of course, they didn't want to do that because you had these sort of warfare, welfare bargain, right? You had the Republicans pushing for war, you had the Democrats pushing for social handouts, and they were perfectly comfortable with that. And so between those three, fundamentally, gold was the one that they broke instead. So, this is the argument for reviving the gold standard, is so that we can put that straitjacket back on. But of course, they would, as always, try to continue breaking it.
Yeah. How realistic is this idea of ending the Fed, or maybe at least limiting its powers under this incoming Trump administration? I mean, we talked a little bit about it. We're seeing some interesting people come into government. You talked about the fact that he wants to kind of, be a little bit more transparent with some of this government data. How realistic is it to limit these powers?
Yeah, so generally, the way that it gets fixed is that you have some catastrophic crisis, and then it's very, very easy to fix. So this was the Soviet Union, right? If you had tried to reform the Soviet Union step by step, like if you'd sat there and gone through every single law, people can sell vegetables out of their car trunks now. All right, that would have taken ages. Instead, the whole thing collapsed and poof, everything disappeared. So that's the traditional way to fix it. The question is, can you fix it before the water starts boiling? And I think that the sort of gateway drug would be the single mandate. So when the Fed was created, the idea was that it would only protect the value of the dollar. That was its only function in life. Well, it was going to do the bailouts, but they didn't talk too much about that, right? What they said to the people is that don't worry about it. They called it at the time the rubber dollar, is what critics called it. So they said, don't worry, we're not going to do the rubber dollar thing. The dollar is going to be good as gold, just like it's always been. So that was the single mandate. And then over time, they expanded that. Democrats expanded that into a second mandate, which is that it's supposed to get the economy growing fast. That's the tissue fire problem. So, you definitely don't want the Fed trying to grow the economy, because the only way you can do it is by artificially stimulating, which always ends in tears. And then you have sort of a tongue-in-cheek third mandate now, which is to save banks from going under. Which, that's because we deployed bailouts on such a large scale in 2008. That's now a third problem. So I think what is achievable before the water boils, at least in the near term under Trump administration, would be trying to pare back certainly that third bailout, which is pretty easy. You just clarify to banks that, we're not going to bail you out. You have to give them a little bit of warning. Otherwise, they would crash immediately. But just tell them that, 2 years down the road, don't expect any help. So you better straighten your things out now. And then on the second mandate, that would probably have to be legislatively repealed, but, no longer actually pushing the Fed towards, being the arsonist when it's supposed to be the fireman.
Yeah, it's been fascinating to watch. It reminds me of the show Friends, where it's just pivot. Okay, you mentioned just now, just a couple of questions back, we were talking a little bit about, this cautious, the fact that you're kind of cautious of the ideas of repricing gold and issuing bonds. Of course, we've talked to a couple of people about this year. We know that Cynthia Lummis, the Wyoming senator, has started to introduce some bills. What about the ideas of selling some of the U.S. gold for a Bitcoin strategic reserve?
Yeah, that's an interesting question. So I'm pro Bitcoin reserve, I'm pro gold reserve. Trading one for the other, I have mixed feelings on. But, I think at any rate, both I think should be expanded. I think it's healthy if the government, however many dollars the government has gotten a hold of, I think it's very healthy if they're putting those dollars into some kinds of savings. Gold and Bitcoin both strike me as prudent places to put them.
Yeah. We just had Ron Paul on the show, a former U.S. representative and presidential candidate. He's a big proponent of ending the Fed as well here. He's also a soon-to-be appointed advisor to Elon Musk and Vivek Ramaswamy's Department of Government Efficiency, DOGE, as we just talked about. So, Peter, could we see the Fed's role change under Trump and with DOGE here? I mean, how realistic is this actually?
Yeah, I think DOGE is an absolute game changer. I think that, I interact a lot with congressional staff and with people in Washington. And first of all, they all know the system is broken. All right. You will never fail to get a laugh from congressional staff saying the worst things possible about Congress. They hate Congress. The people who work there know that it is utterly dysfunctional. It is a mess. So there is no debate on that side. But they're very jaded. Right. They will constantly say, they've talked about cutting costs. It'll never happen. I think, honestly, DOGE is a game changer. And the reason specifically is Elon. Elon is a force of nature. He's somebody who we really haven't seen on this scale. Boy, oh boy, maybe in 100 years since Hearst got involved in helping one party over the other. But we're seeing it now with this continuing resolution out of Congress, where it was the standard warfare, welfare, this bundle of hundreds of billions of pork. And Elon got involved, and holy cow, the rhinos jumped to attention. I think that his ability to primary anybody in Congress out of their seat and into retirement is a very big deal. That kind of threat has not really been present in Washington for a long time. I think it's also notable that he can outbid weapons contractors. Up and down the line, the sort of Wall Street, right? The sort of gods who own our government. He can outbid all of them, and he's very passionate about what he's doing. And I think, honestly, we could see real progress this time around. This continuing resolution battle that we're seeing this week, I think, is sort of a first shot across the bow to warn the sort of swamp creatures that the old ways are over. And, I think that a really important ingredient to the sort of status quo in Washington, right, to why it was so anti-people and anti-voter fundamentally, was the mainstream media. So the mainstream media was generally uniparty. In other words, it was center left. It wasn't hard left, but it was center left. They were, pro Wall Street. The mainstream media would say, the Fed's doing its darndest to fight inflation. Just every uniparty sort of standard belief, right, was advanced by the mainstream media. And so I think what would happen in the old days is that no matter what you ran on, especially as a Republican, you had to govern as a uniparty tool, because otherwise the mainstream media would tear you into pieces and you'd be out of business. I think that if we look at what happened to mainstream media, I prefer legacy media or maybe leftover media. If we look at what happened with them with this last election, where they were, wheeling out the German corporal references nonstop, and it bounced off. I think that we may be in a new age now where the mainstream media doesn't matter. What matters is the alternative media. So there's a Republican media and a Democrat media, and the mainstreamers don't matter. If we're in that new world where DOGE has these incredibly powerful backers, got very, very smart people joining it now, and the mainstream media has lost its role, it's lost its ability to control the narrative and to keep everybody in line on the uniparty platform. If those two changes are permanent, then I think it is a completely different world now.
Yeah, it's fascinating. I mean, Trump just last night having dinner with Elon Musk and, of course, Jeff Bezos. I mean, years ago, you would not have seen that happen. I think he tweeted today saying, "Everyone wants to be my friend." Makes sense, no?
Humility, yes, yeah.
Okay, I want to move on to Judy Shelton. She's a monetary economist and the author of this year's bestseller, Good is Gold. We just had her on our show recently. She posted on X this week, citing an article by Politico, that Trump is poised to replace the Fed as Wall Street's obsession, adding that, quote, the economic policies of a democratically elected president should certainly matter more than the not exactly infallible pronouncements of the Federal Reserve officials. Do you agree with this? Obviously you do.
Yeah, absolutely. The Fed is sort of this quasi-public, quasi-private entity. So first of all, I think it needs to decide what it is. If it's a government entity, then it needs to be obeying the voters. Obeying the voters means obeying the president. If it doesn't, right, and this also comes up when we talk about government workers. If the Fed does not obey the president, i.e. it doesn't obey the voters, then who exactly is it obeying, right? Who is running the Fed at that point? I think the obvious answer is that there is a culture within finance, and people who go into the Fed then come out and they have very nice gigs afterwards. What Janet Yellen was paid, I want to say $9 million at least in speaking fees. So either the people are controlling the economy or $9 million of speaking fees are controlling the economy. So I think absolutely, I agree with Judy, the president should have control over the Fed. Now, the traditional argument against that, what most mainstream economists will say, is that you don't want that because the people or the president are irresponsible about printing money. And, if you look at the Fed over the past couple of years, look at it going back through the 1970s, I would argue that Fed independence is a complete myth. Right? The Fed does what bankers do. It does what the uniparty does, because fundamentally Congress could, in theory, change its mandate. It's never been independent. And why would you want an independent organization? Like, again, this sort of Jedi council of, some imaginary angels who are going to make all the quote unquote right decisions. People have interests. They have biases. It is, some kind of socialist myth that, you're going to get this council of angels who are going to run the world and they're going to be good at it. By the way, we did try that during COVID. So there you go. Yeah. The sort of totalitarian council of angels, that's what it would be for the economy. So yeah, absolutely. I think hand it back to the people. If it turns out the people aren't very good at running the money, well, then I guess we'll just have to go back to gold.
Yeah, interesting. Okay, well, on that topic, gold's seen record highs this year. I mean, I've been talking about it all year long. I think 40 times. Some analysts predict it could reach $4,000 an ounce by 2025. Peter, do you share this outlook? Let's look forward here. In the year 2025, as we're approaching it relatively quickly here, where's gold going and what kind of conditions would support a higher gold price?
Yeah, I have no idea on price targets. I am bullish on gold, which is to say that I think that inflation will continue. The main way that I would be wrong is if Trump manages to grow the economy so quickly that, at least in US dollar terms, that we get very, very stable inflation. Inflation comes down to, say, 1%. The Fed will never let it go negative. They should, but they won't. But anyway, if we get inflation come down, if people expect that long-term inflation is going to be low, then yes, gold probably goes down, just because future expectations of inflation are such a big part of gold prices. But my base case is that inflation is probably going to keep bouncing along at least somewhere between 2 and 3%, partly because the Fed is just not going to ease up. They're already cutting back on quantitative tightening. They're nervous about the economy in general. So I don't think that they're going to continue the inflation fight. And so that would be bullish for gold. Over the past couple of days, we've had some moves down in gold, but I think that's just standard liquidity. Whenever people are nervous in markets, they sell the good stuff with the bad. But I think gold's going to recover pretty quickly here.
Yeah, we've seen the same with the Dow, the S&P, NASDAQ too. After that FOMC meeting, quite a correction, but it's come back positive. Do you see the same with Bitcoin? I mean, obviously this year it's been a complementary role to gold as kind of that hedge against inflation. A lot of people understanding currency debasement. What's your outlook for Bitcoin next year?
I'm very bullish on Bitcoin. I think that there's a couple moves in there. One of them is the strategic Bitcoin reserve. That is actually doing surprisingly well in the betting markets. It looks like 60+% odds that we actually get that installed. That would be an absolute game changer. Other countries would have to imitate the US. It would be a massive sort of official mark of approval on Bitcoin. States like Florida and Texas, generally red states, are already starting to float some kind of a Bitcoin reserve. And then, of course, you have the regulatory changes. So the Bitcoin ETFs, those were a game changer because a lot of people in Bitcoin assumed that sooner or later the US government was going to come after them regulatorily. And, once the Bitcoin ETFs came out, you had a lot of major Wall Street players like Fidelity or BlackRock who went from being outside Bitcoin to inside Bitcoin now. And then if you pair that with, Trump, love him or hate him, one of the unique things about Trump is that he absolutely pays back his friends, right? If he feels that you are on his side, he will do everything he can to help you. And he feels that anti-Fed people, so kind of Ron Paul libertarians, and especially Bitcoiners, were on his side. He feels like he owes them. He's going to do everything he can to help them. So you put those two together, we're already seeing people like David Sachs, who are Bitcoiners, go into leadership positions, Lutnick, Besant. All of them have been pro-Bitcoin. So I am extremely bullish on Bitcoin over the next couple of years under Trump.
Okay, I got to ask you about the general markets then too. I mean, a lot of investors asking what the top advice is going to be going into next year. As I mentioned, we've had those all-time highs on gold, Bitcoin. We've seen it in the markets, in the indices. What are your thoughts? I mean, if you're a general investor right now and you're looking at a year of uncertainty, where are you putting your money?
I still assume that the most likely outcome for next year is going to be faster economic growth. I think that, Trump's reforms, you're already starting to see an impact on consumer spending. I think that that's going to filter through into investment spending. That then, grows the economy, it grows wages. So my base case is that we're going to see a rebound in growth. I don't know if it'll be strong enough to counteract what I think is sort of the hangover from the sort of hidden Biden recession. But I think that we're going to have a resurgence in growth and that's going to be good for markets. So I myself am positioned for a boom. Nice. I am not certain of it. I think it's maybe 2/3 chance of a boom, 1/3 chance of a crash, but I'm positioned for a boom.
Okay, still a little majority there in the wager. Peter St. Onge is an economist at the Heritage Foundation. And of course, like I said, a leading voice in Austrian economics. You need to check out your podcast as well. Thanks for this, Peter. I really appreciate your time today.
Of course. Thanks for having me on, Jeremy.
Thanks, mate. Have a great holiday season. And also a big thank you to our sponsor, Goldback. If you're hearing about Goldbacks for the first time, they're an innovative way to own real spendable 24-karat gold. Each Goldback is a physical gold note made through advanced technology that embeds pure gold directly into a lightweight, durable form. So when you're holding Goldback, Bill, you're actually holding gold. At a time when inflation and currency devaluation are on the rise, Goldback offers a way to protect your wealth that goes beyond typical cash. Since each Goldback is made from real gold, its value grows along with the price of gold, giving you a hedge against inflation that cash just can't provide. And because Goldbacks come in smaller denominations, starting at around $5, they make it easy to own gold without the need for a larger investment up front. But Goldbacks aren't just for storage, they're designed to be used. Accepted as legal tender in over 5 states with a growing list of over 2,000 businesses, Goldback allows you to make purchases big and small, from a morning coffee to groceries to larger expenses like a new pair of shoes, car repairs, or even chartering a flight. Now, they combine the long-term stability of gold with the flexibility of cash, making them a practical option for everyday spending and a strategic addition to your savings. Goldback even offers a unique opportunity to earn interest, which is paid back to you in more Goldbacks, helping you gradually grow your gold holdings. Of course, if you're interested in learning more about how to start using Goldbacks as a secure, versatile way to hold and spend real gold, visit goldback.com or click the link in our description. It's a simple, powerful way to make sure that gold is part of your financial future. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. Have a great season. We'll see you next time.
This Kitco News interview is brought to you by Goldback, inflation-resistant, 24-karat gold currency. Protect your purchasing power, grow your wealth annually, and spend at over 2,000 businesses. Learn where to get Goldbacks at goldback.com.